Hello guys, ETM Effects and welcome to our Institutional Supply and Demand course. Our goal is by the time you're done with this course to have a mass knowledge on supply and demand trading concepts and what it has to offer. So get ready. So to start things off, what is the why behind supply and demand trading? It's an exchange that is predicated on the price of a variable in the marketplace at a certain time. Basically, it's an exchange. It's an exchange between two parties that at that moment of the transaction think they're both winning. One person is trying to buy something because they think it's at a cheaper rate, and somebody's trying to sell something because they feel they can make a profit off the sell. In simpler terms, it's buying low and selling high. It's buying at a discounted rate, which is cheaper, and selling at a premium rate, which when price went up and is higher. So for an example, let's use the shirt as the variable. So here we have the ETM shirt, and let's say the starting point is $5. This is the fair price. And you want to buy the shirt to later on make a profit. You would want to wait for the shirt to go from $5 to $2.50, or even somewhere around $1 or somewhere around 50 cents to later on purchase the shirt from somewhere here to later on take it and maybe sell it at $5, which would be the fair pricing of the shirt that the market determined, or sell it for when the shirt increases in value somewhere around $8 or maybe $9 or even $10. This would make way more sense. Why? Because let's say you purchase the shirt at $2.50 and you purchase the shirt at $2.50 and it just sinks. It goes to zero. The shirt becomes worthless. So what do you lose? You lose $2.50. But if you would have bought it at fair price and the price and the shirt went worthless, you would have lost $5. So your risk is bigger. But let's say you bought the shirt at $5 and price went up to $8, you would have made $3 profit. But here, if you would have bought the shirt somewhere around $2.50 or even $1 and the shirt went up to $8, you would have made a $7 profit. So what it does is buying something at a discounted rate would increase the profit margin, would increase your chances and decrease the risk at the exact same time. So you always want to purchase something when it's at a lower pricing and then sell it when it's at a higher pricing. So let's attack this scenario as a seller. So let's say you already own the shirt and you purchased the shirt for $5 and you're looking to get rid of it for whatever reason it may be. You don't believe that the shirt can go up in value anymore, or you need the money, etc., etc. So let's say the price drops to $2.50. If you sell the shirt at this price, you would be negative $2.50 because you purchased it for $5. But let's say price goes up to $7.50 to $8. If you sell it now, you'll be positive $3 because you sold it as the value of the share went up. So what I'm trying to explain to you here is it's always best to sell when price is at its premium pricing, and it's best to buy when price is at its discounted level. The key points here is best to purchase and sell the shirt at price extremes. You would always want to purchase something that is discounted, that is low, and you would always want to sell something when it's premium at its highest pricing. So how to put all this into price action? Before we do that, we need to understand what a range is. And I've covered this plenty of times on my website and on YouTube in the free Smart Money course, but let's go over it real quick. We're not going to take too long in this. So you have your low, you have your high. You have your low, price breaks your high, comes back into the range, and validates this as our new high, and the low that caused it, the lowest low prior to the movement that broke the structure, would be our low. So this would be our true range. Again, price breaks structure, comes back. This low, this would be the low, and this would be the high, and this would be our range. Let's say price breaks structure again, comes back into the range. This would be our high, and the lowest low prior to the break would be our low. So this would be our range, and etc., etc. Here's a chart example. This was our range, this was our high, and this was our low. Price broke structure, As you can see, when it broke structure right here, this was the previous range. Price broke structure and closed inside of the old range. Doing what? Confirming that this is our new lower low and this is our new lower high. Why this lower high? Because this is the last high prior to the structure break. And once it comes back into the range, it validates this as our new range, and etc. etc. So let's say price comes up right here, breaks here, comes back. This would be our new lower low, and this would be our new lower high. So how to combine what we learned so far together using one tool? Fibonacci. The 0 level to 25 is our discount level. The 75 to 100 is our premium pricing, and 50%, this whole area, is fair pricing. And remember, guys, always go back to our t-shirt ideology, right? You always want to go back to, oh, why is it beneficial for me to purchase something right now at this specific pricing? Here we have a range. Here we have our high. Here we have our low. Price broke structure. Once price broke structure and came back into the range, you pull out your fib. You get your new range. This is the old range, guys. This is the old range. The old range that is right here. This and this. But once price broke structure and came back, you put the fib on your new high and your new higher low. And this would be your premium and discount range. So once price gets anywhere in the discounted area, like we said back when we were talking about the shirt, it will be cheaper to purchase the shirt at this rate. You would want to purchase price right here to then sell it off at a premium pricing. And that's what happened here. Price came back down. You purchase price right here. You can sell it off right here, or you can sell it off at its extreme, super extreme. So let's use an in-chart example. Here we have our high and here we have our low. Again, this is our high. This was our low. Price is trying to break the high, but it didn't close above. So we're still within this range. Now price broke the range. Let's see if price comes back into the range. Price came back. Oh, not yet. It needs to close above and then close below. Wicks are FTC. That's a whole complete different scenario. And we taught that previously, and we'll make more lessons on that. But for right now, just focus on candle closes above the range and closes back inside the range. Okay, now you can say price closed inside of the range. So what do you do now? You shift your range. This is your new high. And this is the last low that caused this break. So this is your new range. So what do you do now? Pull out your fib and you mark up your premium and discount zones. Where's obviously price broke structure bullish. So we're looking for a buy. We're looking for price to continue bullish. Where would it make sense to buy pricing? If you were the banks and you were ready to inject heavy liquidity into the market, where would you purchase the price? Where it's cheaper, which would be in our discounted area. And price reacted. Price did what? Price reacted from our discounted area. But in this instance, price sold off and went back to being worthless. But what happened here? Let's go back to the t-shirt theory. Let's say price here was purchased. Look at where this wick is. Price was there. If we're going back to our $10 theory, price was purchased at $1 and it was sold back at $5 at our fair pricing. So the profit has already been made. So after the bank sold off price at fair pricing, They decided to tank the price, making the range worthless, taking it back to zero. So, so let's look at this example. We have our low, we have our high, price broke, closed below, indicating price want to go bearish. Price came back, closed inside of the range. This is when you pull out your fib. And you're waiting for what? A sell at the premium pricing. And this would be an ideal situation. So let's look at this situation. This would be more of like an advanced structure lesson going on supply and demand, but I'm going to cover it just because. Here we have our range, we have our high, we have our low. We have our high, we have our low. This is our range so far. Price broke structure and closed below and came back and closed in. So what do? You pull out your fib. You're waiting for price to do what? You broke structure bearish. So you're looking to do what? You're looking to sell the market. Where would it make sense to sell the market? In our premium pricing. But look what happens here. Price never reaches our premium pricing, doesn't even reach our fair pricing, and breaks the low. So what happens? Once price breaks the low, this will be an intro to a new range. So the low that was broken right here and the last high that prior to the break. So this is our range. So what are we waiting for? Waiting for price to come back into our new range. Price came back into the range and closed inside. So what do you do here? Pull out your fib. And what are you waiting for again? A sell at our premium pricing. Price reacted. Offloaded at fair pricing. So again, go back to our short theory. And sold completely off, carrying on the trend. So what are supply and demand institutional candles? A supply and demand candle is a candle where the whales, whoever they may be, enter the marketplace and is visible in the charts via candle form. So what do we mean by whales and whoever they may be? It could be the banks, it could be large players. What it really means is a large sum of money entering the market, and we can see that printed on the charts. A large sum of orders are injected into an asset class, causing a rapid reaction. In simple terms, it's the last bear candle before a bullish expansion, or a last bullish candle before a bearish drop. So as you can see, this is a demand candle. And what is it? It's the last bear candle before a bullish expansion. This is a supply candle. A last bullish candle before a bearish drop. And what qualifies it? Because as you can see plenty of them all around the charts. Most importantly, they're the ones that have a strong reaction and they break a significant resistance level. When price revisits the supply and demand candle zone, price will ideally reject. So when price comes back to this area, it's more than likely to reject. As you can see, we have our last bull candle before a bearish drop that did significantly break a resistance level. Later on, price comes back into the zone to later on reject. Same with here. We have a last bear candle before a bullish expansion that caused a structure break right here. Price comes back. When it comes back to this area, it's more than likely to react and go bullish. So let's go back to our example from earlier. Let's locate our institutional candle. This would be our supply candle. Why is it our supply candle? It's the last bullish candle before a bearish drop. A bearish drop that caused multiple resistant breaks. So when price comes back and revisits this candle, it's gonna get a reaction. But why did we choose this candle aside from the resistance breaks. It's the fact that this candle is in our what? Premium pricing. When you're looking for supply candles, you're looking for them to be in our premium pricing. If you're looking for a demand candle, you're going to be at a discounted pricing. So let's go and check a discounted institutional candle example. So here we have our range set. Price broke structure and came back, insinuating that it wants to come back inside of our range. What do we do next? Plot our fib and look for our discount pricing. Why do we look for our discount pricing? Because price broke to the bullish side, indicating that price wants to go bullish. So we're looking for a buy opportunity where in our discounted area. So now that we have our discounted area situated, we're going to look for our institutional candle. Here we have a demand candle that is in our discounted area, but not all the way, right? And this is a trick you could use as you're developing as a trader. As you can see, the candle is a little bit above our discounted area, so you can just shrink our zone up to the discounted area. So we're using this institutional candle not just because it's in a discounted area, but because it also caused a major resistance break. It broke structure. This entire candle forced this entire move of breaking this major resistance. What does that mean? That means there's a lot of orders that's been inserted in this candle to force this entire move. So when price comes back to this zone, it's more than likely to reject. Price rejected. So now that we know what institutional candles are, let's build context around them. Where do they come from? Why do they print on the chart the way they do, etc., etc. But to understand that, we need to understand what a base is first. So what are bases? Bases are, to keep it simple, an accumulation, a consolidation. What happens in this consolidation? Orders get put in from whales, from banks, whatever the entities may be. Price starts consolidating because there's an indecision. It's accumulating orders. Once there's enough orders in this consolidation, price picks a direction. So when price comes back to this area, it's either going to reject if there's still enough orders left from this entire move, or it's either going to reject or it's going to rush through. So look at it like this. You have a consolidation here. And let's say, to keep in simple terms, let's say $200 were put in this consolidation. There was $200 injected in this consolidation while price was accumulating orders. And price broke bearish. So for them to move price from here to here costed them $150. This is all hypothetical. This is an example. So when price comes back to this area, there's still $50 left in this accumulation. So when price rejects from this area, he'll reject $50 worth of rejection to later on break through. Why did it not continue down? Because this move cost them majority of the money they accumulated in this accumulation. So let's go over another example. You have a consolidation here and price broke. Let's say this consolidation was $500. Again, hypothetical. It's hard to know how much money is injected in this. I know a lot of people use order flow and etc., but it's still pretty hard, especially when it comes to Forex. When it comes to stocks and let's say indices like NAS 100 or SPX, you can have better clues using time and sells and etc. of how many orders are printed. But still, there's a lot of orders that you can't see. So in my opinion, it's really hypothetical, right? But let's say this accumulation accumulated $500. For them to expand this move all the way here, let's say they used $200. So they still have $300 left. So when price comes back here, it rejects because there's still money left in this consolidation, in this base, for price to react and break through. Why? Because it cost them $200 to make this move. So they still have $300 left to push price higher. So the move will obviously be stronger than the previous one. So just for beginner's sake, how do we identify a consolidation to then later on say it's a base? Consolidation is when price picks a range. Let's say this is the range, and price fails to break that range. So say comes back here, instead of breaking above, comes back down, even though it was insinuating that price is on a bullish trend. So it's supposed to break the bullish structure, but it didn't, and it stayed within the range. This would be identified as a consolidation. So here we have a consolidation. Price stayed within this range and this range, failed to break right here, came back here, failed to break again, to then later on break, and he had a fair reaction that broke previous rejections level. So here we have our one base. Let's find the second one. Now price broke through here. Okay. So here we have a base. Price picked the range and stayed within the range until eventually breaking out right here with a strong reaction. And as you can notice, price accumulates order to then later rapidly get out of the range. It always happens. The first few candles out of a range break are usually bullish with a strong momentum. So let's stretch this one out first. Price broke out of the range, out of the base, came back, retested the base, and continued higher. What does this indicate? That there was enough money in this base after the initial expansion. So again, let's go back to our hypothetical theory. If there was $500 here, price used, let's say, $200 to make this move. So when later price comes back, there's still $250 left for another expansion move to take out this high that was caused by this $200 move. That's how you want to kind of look at it. So let's go to our old base. Let's stretch it out. I don't know if price revisits it. What happens here? Price reacted from this base, but the reaction wasn't strong enough for price to continue lower. There wasn't enough money in this base for a full move. There was just enough for a reaction. So let's go back to our hypothetical scenario. If there was $500 here for price to make this move, which is actually this entire big move, let's say price used around $450 to make this entire move, and it is a huge move. So when price comes back to retest this base, there's only $50 left, which is enough for a small reaction for price to fail to break lower to then break the base and continue higher. So this is just an overview on the base. We can really get really deeper into base. We'll do that in another video. But for right now, just focus on basics of the base. For a little bit more knowledge on bases, there's two types of bases. There's continuation basis and reversal basis. Continuation basis are rally base rally and drop base drop. So what is it? It's a rally, which is an expansion, forms the base to then on rally. This is a continuation. Price continues going up. This is a drop base drop. It's a drop going on a base to then drop, still following the same direction. So this will be the continuation phases of bases. And here are reversals. It's a drop, base, drop. And here's a rally, base, rally. So these would be for reversals. So let's say you want to retest this base. You would look for a test right here following a reversal. And here you would look for a continuation for a price to follow up on the base to then later on expand and continue with the same direction as initiated previously. So what is the relationship between bases and institutional candles? And guys, this is something that I haven't seen on the internet prior to this. This will be the first time this is available on the internet because I haven't seen anybody cover this yet. What is the relationship? The relationship is institutional candles slash supply and demand candles are higher time frame bases. How? This would be a higher time frame institutional candle. This is an institutional candle. On the lower time frame, it's a base. So it'll be the range low, high, and price consolidated in the middle. So let's combine everything that we learned so far. How are we going to trade this base? Why is this a base? Is because the range was set right here. This was our low. This was our high. Price came back down, failed to break right here, came back up, failed to break, just to later on have a strong reaction out of the range. The two failures to break indicated that this was a consolidation, which would then, thanks to the reaction, would later on be a base. And what kind of base is this? This is a rally base drop. So how would we trade this range? First, we want to see how it looks like on the higher time frame as far as an institutional candle aspect. On an institutional candle point of view, here is our supply candle. Here's our supply candle. But instead of taking an entry right here, let's go back to our base and see how this base looks. What we do here is we want to get the 50%, the fair value pricing of the base. Somewhere where there was indecision in the orders. If we know there were a lot of orders getting printed in this area, we want to see where they had to make the decision. Where they would have to make the decision, we can always go back to the t-shirt. It would be the fair price, would be the 50%. So let's mark the 50%, which is right in the middle. Here is our 50% area, where is the institutional candle, the daily institutional candle? It's this one right here. But let's make it smaller. We want a lower time frame institutional candle that's close to the fair price of the base. And this is our last institutional candle. On a lower time frame. So this is our candle. So now we can remove everything, or at least we can remove the fib, and we can actually keep the base, and we can remove our fair price line since we already found our institutional candle. And let's wait for price to reach this area. We would expect a rejection from this area. And here's our reaction. Here are three key factors if you want to trade reversal. These are three things that you need trading reversal. First, Your base slash institutional candle being in premium or a discount zone. As you can see, price breaks to the bullish side, you wait for a discounted area, and vice versa. A strong reaction out of the base. As you can see, you have a base right here and a strong reaction out of the base, and the candle being the origin to breaking the range, which, let's say there's an institutional candle right here. This institutional candle is responsible for breaking this range. So these are the three key factors you need to trade reversals. So last but not least, how would you trade a continuation, a rally base rally or drop base drop? So in this instance, you have your range, price took out the previous high, insinuating the price want to go bullish. So knowing that, we know that we should look for a rejection where in our discounted area. So we get our reaction in our discounted area, and price is continuing up. So what's our next step? We want a base surrounding the fair price. Why fair price? Because we already got the reaction here. The money's been inserted. The order's been already inputted in this area right here. And we want to take price from discount to premium. So we want to take price from low to high. Buy low, sell high. Same thing we've been doing this entire course. So I would want price to form a base right here, break the 50% and come back into the base and to take it back right here. And this will be pure zonal trading. So price completely broke the 50%, the fair price. And where is our base right here? We would mark up our institutional candle. We have a strong reaction. We broke a micro resistance. So we would wait for price to bounce up from here and potentially take price from a rejection here all the way to our premium level. So let's cover supply turn demand. Let's say you have a range, price broke outside of the range, price came back, and you're waiting for your demand candle in your discount zone. So price is approaching your demand zone and broke it. Did not react, did not hesitate, with full momentum broke your demand candle. So what happens when price breaks it with full force? Expect a retracement back to that level to later use that force to continue with the direction the candle initially broke the zone. Why is that? Let's break it down. So we can always go back to our hypothetical theory. There is $300 here. There's $300 in this area right here. So when price comes back here, this money needs to be used to push price bullish. But when price approaches this area, it breaks through. What does that mean? That means there might be $300 waiting for you in the demand zone, but the selling pressure, whoever sold here and here, that's pushing price to go lower, sold way more than our initial $300. So when price comes back here and returns to this area, there is still money left in this area to push price lower. Why? Because people sold in this area. Instead of buying, people sold. So there's still sell orders here ready to go. So once price comes back to this area, expect price to push, expect this zone to push price bearish. So look at this example. Price broke structure right here and came back into the range. So we expect our demand candle to be in motion, but instead of reacting from our demand candle, price shot right through it with no hesitation, with no slowing in speed, rushed through it. What happened here? our demand candle turned supply. Why? Because there was no hesitation, no reaction. If there was a minor reaction, we can say there there was a reaction from our demand candle, but not enough orders to push price forward. But if it completely just ignored the demand candle, that means this demand candle turned into a supply candle. So when price revisited this area, they used the sell orders injected here, whoever sold here, here, to nullify this demand candle. These orders are still here. So once price comes up here, it reacts from this demand turn supply area and drops. Same with here. Price was obviously in a bearish trend, making lower lows. Price made a lower low. You would expect a sell from the supply area, but price rushed through it rapidly, came back, revisited this area. This will be supply turn demand. Use the buy orders that push price through the supply candle to continue price up. So let's go into an in-chart example. So here we have a correct demand turn supply setup. This last candle, this last bearish candle before this bullish run, this bullish run broke 1, 2 significant resistance. But in reality, this candle is responsible for this entire move. So, and it's in our discount zone, going based upon the previous high. So we would expect price to come here and react over this area, but it didn't. Price came close to this area and pushed back up, but did not touch it. And the next time it came through, it just blasted through it. It never came up for air to then later break on. There was no reaction from this area. Okay, if we get our candle spot on right, we would see that there was no reaction from this candle. Price just rushed through our demand area. So when price revisits this area, we can expect that this demand area turns supply and these buy orders were overtaken by sell orders. We can expect that more money was injected here, here, and as price was passing, there was more money here, here, into more sell orders to push price through our demand zone. So when price revisits this area, we expect a reversal. As you can see, we got a reaction. Now, whether price comes back once or twice, that's a complete different topic. But to understand demand turn supply or supply turn demand, you need to understand that if your demand or supply candle gets broken through with force and it was a validated demand candle or supply candle, then that demand or supply candle will more than likely reverse roles. So let's go over a incorrect setup. Here we have our supply candle. We have our supply candle, price broke structure, formed a low. This is our range now. And if you retrace it, this supply candle is in fact in our premium level. So we're going to see what happens. Price breaks through, but not fully yet. So price still might react. We still don't know the outcome yet. Price reacted, but broke it. So seeing this reaction, would this turn to a supply turn demand candle? Absolutely not, because of this reaction. Price came up to this area, found the sell orders. Price tried to go lower. There was not enough sell orders to push price lower, so price shot through it. So this will not turn into a demand candle, and you will see. this would be an incorrect entry. Alright guys, I want to thank everybody for checking this course. Make sure you like, comment, share, subscribe, and make sure you check our website